Hello friends, I welcome you in my another video, and today's topic is the comparative analysis between the new ODI regime and the old ODI regime. So that is between FEMA 120R and FEMA 400. So we are going to cover basically the difference and the key changes made in FEMA 400. So first thing is whether OI regime is applicable or not applicable. So as per the existing guideline, there were certain cases where the ODI regime was not applicable. So it was if the investment made by the person resident in India out of three categories of these funds. First of out of the funds held in resident foreign currency account, and second is as bonus share on existing holding of the foreign currency shares, and when not permanently resident in India out of their foreign currency resources. It means when a person is not permanent resident in India, but he has made the investment out of the foreign currency earning resources outside India. So in that case, this ODI regime was not applicable for these three category of cases. Now, in case of new ODI regime, the exception for the applicability of OI regime is as under. First is any investment made outside by a financial institution in IFSC. Okay, so the first category is if any financial institution is making any investment in IFSC Gift City Gandhinagar, then it is exempt. That is that OI is not applicable. Then acquisition or transfer of any investment outside India made. How it is made? First is resident foreign currency account. So the same thing which was there last regime also, yeah, old regime. Okay. Then another out of the foreign currency resources held outside by a person who is employed in India for a specific duration. Okay, irrespective of the length thereof, or for a specific job or assignment duration of which does not exceed 3 years. Okay, so if any person is temporarily employed in India but he is making his investment out of the foreign currency resources, then the OI regime will not be applicable. Then the last third point is in accordance with subsection 4 of the section 6 of the Act. So Act means the Foreign Exchange Management Act, and the section 6 talks about the capital account transaction. So subsection 4 is the basically a section where it permits a capital account transaction for the person as an inheritance, or already he's making investment out of their foreign currency resources. Then meaning of ODI. So in case of existing ODI or old ODI regime, it was direct investment outside India means investment by way of contribution to capital, subscription to the memorandum of association of a foreign entity, or by way of purchase of existing shares of a foreign equity either by market purchase or private placement or through stock exchange, but does not include portfolio investment. Okay, so this, even though the debt part was also under the this meaning of ODI, but the definition was more as a equity investment or instrument they were talking about, but there was not any cap. Okay, but in new ODI regime now the cap is defined. Okay, so the overseas direct investment means acquisition of any unlisted equity capital, okay, or subscription as a part of the memorandum of association of a foreign entity. Okay, so this is the first category. Or second, the investment in 10% or more of the paid up equity capital of the foreign entity. Okay, so 10% or more paid up capital of a listed of a equity capital of a listed foreign entity. So listed word is very important. So 10% or more listed foreign entity capital. And the third is, even though it is less than the 10% paid up capital, but with control. Okay, so in the listed company, less than 10% but with control. So this is the definition of overseas direct investment under new regime. So this is the basic difference. So the definition has become clear in respect of overseas investment under ODI. Then financial commitment. So under the old regime, the financial commitment means the amount of direct investment by way of contribution to equity, loan, and 100% of the performance guarantee, 50% of the performance guarantee issued by Indian party to or on behalf of its joint venture company or wholly owned subsidiary. So basically it was 100% equity, preference share, loans, guarantee, bank guarantee, but 50% of amount of performance guarantee. Okay, so there was a criteria of percentage of certain instruments. So if it is a performance guarantee, then 50% amount of the guarantee was considered as financial commitment. Other than performance guarantee, remaining instrument was for 100%. But under the new ODI regime, the definition of financial commitment has changed to as the financial commitment by a person resident in India means the aggregate amount of investment by way of ODI. Okay, so ODI we have already seen what is the meaning of ODI. Okay, then debt other than overseas portfolio investment. Okay, and non-funded facility or facilities extended by it to all foreign entities. Okay, so now the non-funded facility, whether it is bank guarantee, performance guarantee, any guarantee, so there is no 100% 50% criterion. Now these there are three categories. First is investment by way of ODI, so that is your equity capital. Then debt other than the overseas portfolio investment, and third they have included is non-funded facility. Okay, or facility extended by it to foreign entity. Okay, so no financial commitment is allowed in a foreign entity if it is resulting in having two layers. Okay, so that restriction was not there, but RBI has made it very clear that under the new ODI regime that no financial commitment is allowed where there is a second layer of subsidiary. Okay, so the definition has been amended to include equity, debt, non-funded facilities. The definition has been modified to cover nature of investment. Okay, instead of nature of instrument. So this is very important. Okay, now Indian investor. So this is the person who is making overseas investment. So in the ODI regime, that is old regime, the Indian investor was defined as Indian party. So Indian party means a company incorporated in India, a body created under the Act of Parliament, partnership firm registered under the Indian Partnership Act, or LLP registered under LLP Act 2008, making investment in joint venture or wholly owned subsidiary abroad, and includes any other entity in India as may be notified by the Reserve Bank. Okay, so since it was the concept of joint venture and wholly owned subsidiary, since now this concept is not there because the foreign entity has become as the the investee company. So there is no more concept of JV and wholly owned subsidiary for the purpose of ODI. So now that's why they have changed the definition of Indian entity. Now Indian party has become the Indian entity. So the accept concept of Indian party where all the investors from India in a foreign entity were together considered as IP has been substituted under the new ODI regime with the concept of Indian entity, where each investor shall be separately considered as Indian entities. So friends, in the old ODI regime, there was a provision where all Indian party put together were considered as a single Indian party. However, in case of Indian entity, now they will be treated as separately. So Indian entity means a company defined under Companies Act. First is a body corporate incorporate by act of law for the time being in force, a limited liability partnership under LLP Act and registered partnership firm. So friends, there is no mention of individual. Okay, you can see there is no mention of individual in the definition, but under the LRS, the resident individual are, are allowed to make overseas direct investment up to the limit of LRS, that is 2,50,000 per financial year. Okay, in old regime, when more than one such company, body or entity make an investment in foreign entity, all such companies or body or entity shall together constitute Indian party. Okay, that we have already discussed, but in new regime, each investor's entity shall be separately considered as Indian entity. So this is the difference in the new ODI regime. Then foreign entity. So as we have discussed that in the existing old ODI regime, there was a concept of joint venture and wholly owned subsidiary, and they were commonly referred as foreign entity. However, in new ODI regime, there is a concept introduced. Now the definition has been given for foreign entity. So it means an entity formed, registered or incorporated outside India. Okay, including in, so it means if the entity is incorporated outside India, and even though if it is incorporated in international financial service in India, that is Gift City Gandhinagar, then they are the foreign entity. And the most important condition is they have that has the limited liability. Okay, so unlimited liability is not allowed for overseas direct investment. There are certain exception. We will see them, or we have you can refer my first video where we have talked about the exception. Okay, so the definition has been provided to give a single name to the investee company under the new ODI regime. Okay, so now the JV and wholly owned company, wholly owned subsidiary, they have become the foreign entity. Then net worth. So because as we know, there is a cap, you cannot go beyond 400% of the net worth of the investor company. Okay, so so in the existing ODI, the definition was the definition for net worth was paid up capital and free reserves. Okay, but now in the new ODI regime, the definition has been aligned with the definition given in the Companies Act as per section 2 and subclause 57. So the what is the definition of section 257? Net worth as the aggregate value of the paid up share capital and all reserves created out of the profits and security premium account after deducting the aggregate value of accumulated losses, deferred expenditure and miscellaneous expenditure not written off as per the audited balance sheet. As per the last audited balance sheet, actually in ODI the word is last audited balance sheet, but this is the definition of Companies Act. Okay, so audit but does not include reserve created out of revaluation of assets, write back of depreciation and amalgamation. Okay, so what is the difference between the net worth under the old regime and the net worth under the new regime? So in the old regime, the net worth simply means the paid up capital and free reserves. Okay, but in the new definition, they have excluded what? Revaluation reserve and any miscellaneous expenditure to the extent they have not been written off. Okay, so the definition has become more conservative as now it deducts revaluation reserve and other miscellaneous expenditure from the asset from the net worth. Okay, now utilization of others net worth. So under the existing or old regime, there was a concept of utilizing the net worth of subsidiary or holding company by the Indian party. Okay, because if your net worth is not sufficient, then there was a concept to borrow the net worth from your other group company or a holding company. But under the new ODI regime, the concept of utilizing the net worth of subsidiary or holding company has been discontinued. Okay, so even though they are the group company or associate, they are permitted to give the guarantee, they can create the charge also, but the concept of borrowing the net worth has been dispensed with. Now the last audited balance sheet. So because when we study the definition of the net worth, then we came to this terminology is last audited balance sheet. So in the existing ODI regime it was not defined, but under the new ODI it means audited balance sheet as on date not exceeding 18 month, okay, 18 month x month preceding the date of the transaction. Okay, so though any balance sheet will be okay, but it should not exceed the 18 month from the date of transaction. So you have to give the audited balance sheet within the 18 month from the date of transaction. It means for the calculation of net worth you can consider the audited balance sheet which is not prior to 18 months, correct? Now, subsidiary and step down subsidiary. So, as in the existing ODI, there was a concept of JV and wholly owned subsidiary. So, these terms were not defined. However, now since the new ODI regime has done away with the concept of JV and WS, so in the new ODI regime, the subsidiary and step down subsidiary they have defined. So, subsidiary of a foreign entity means an entity which the foreign entity has control and structure of such subsidiary. Step down subsidiary comply with the structural requirement of a foreign entity. Okay, so that is the limited liability and the that structural requirement is basically given. Okay, that is such subsidiary shall have the limited liability. Okay, so this is the very important thing, limited liability, where the foreign entity's core activity is not in the strategic sector. So okay, so if it is strategic sector the exception is given, then the limited liability may not be mandatory, but other than this strategic sector, the limited liability, the compliance has to be there. It means the structure of the foreign entity must be the limited liability company, or the it must have the any instrument through which the liability of its shareholders is limited. The investee entity, it means the you know the foreign entity of the foreign entity where such foreign entity does not have control as defined above shall not be treated as the step down subsidiary. So this is basically going another layer where it does not have any control, then it will not be treated as step down subsidiary and therefore need not to be reported henceforth. So where the foreign entity is not having any control on the further step down subsidiary, then it is not required to be reported under the ODI regime. Then promoters group. So in the existing ODI regime, the promoter has the same meaning as defined in the Security and Exchanges Board of India Disclosure and Investor Protection Guideline 2000. The definition has been removed now. Okay, with a view to provide more flexibility in considering the asset for creation of charge players in India, the asset of the promoters, director, group company are allowed and accordingly it will be considered for calculation of financial commitment. So basically, uh, uh, the definition is not there, but they have included the promoters, director and group company associate for creation of charge, and it will be taken as financial commitment. Now the control, this is very very important, because for an investment to be classified as overseas direct investment, the control becomes very important, even though if it is listed company or unlisted company. So in the old regime it was not defined, but under the new ODI regime it is defined. Okay, so what is the control? Control means the right to appoint majority of the director or to control the management or the policy decision exercisable by a person or a person acting individually in concern directly or indirectly, including by virtue of their shareholding or management right or shareholders agreement or voting agreement that entitle them to 10% or more of the voting right. Okay, so 10% of the more voting right is very important. Friends, this definition we have discussed in our this ODI part 1 very in detail, part 1 or part 2. Okay, so basically we are just talking about the difference between the new ODI and old ODI regime. So under the new ODI regime, the controls become very important to qualify as investment as ODI investment. Okay. Next, late submission fees. So this is, the game changer of this new ODI regime. Earlier, there was no late submission fees for any delay reporting or filing, and it was not defined. But, for ECB and FDI, there is late submission fees already there. Okay, so to RBI has aligned this late submission fees for all capital like FDI, ODI, and ECB. So in new ODI regime, in case a person resident in India has made a delay in filing, submitting the requisite forms, return document, such person may submit the requisite form, return document, etc., and pay the late submission fees through the AD bank in accordance with regulation 11 of OI regulation. Okay, so basically now there is a concept of late submission fee. So suppose any the investor or Indian entity, they are not reporting any transaction in timely manner, or suppose their transaction is already delayed under the old regime, then RBI has allowed a timeline of 3 years. Okay, the timeline is given, the window is given of 3 years to regularize these transaction for uh, by paying the late submission fees. After 3 years, the investor, they would have to go under the compounding route. So friend, this is very important things. If you are one of the investor, or you are the Indian entity, then please take care of this requirement. Then pending reporting and filing. So it was not there, the provision was not there. But in the new ODI regime, AD bank shall not facilitate any outward remittance or further financial commitment by a person resident in India towards a foreign entity until any delay in reporting is regularized and may be guided by the regulation 12 of OI regulation. Okay, so friends, this provision was not there in the earlier existing ODI regime. So now this provision is there. So if there is any pending reporting which is not regularized, so friends, please take care of this requirement. AD bank cannot and should not allow any further financial commitment till the existing delay is regularized by way of payment of late submission fees till August 2025, which is the window available for regularizing all the delay reporting or filing. Okay. So with introduction of this provision, RBI has restricted any further financial commitment till any delay in filing or reporting is regularized under the LFSUB windows. Okay, friends. So here the important thing is, so suppose if any reporting is pending for a particular UIN, or we can say the foreign entity, so till the reporting or the filing is not regularized, you cannot make any further financial commitment in that foreign entity. Now the overseas portfolio investment. So in earlier it was not defined. Okay, but now the overseas portfolio investment means investment other than ODI. We have seen the definition of ODI in foreign security. Okay, so anything after the ODI, it will be treated as overseas portfolio investment. So the definition has been provided in the regime to have clarity and control execution and reporting of OPI transaction by Indian entities. Strategic sector. Strategic sector, it was not defined and not included, but under the new ODI regime, it is defined. The strategic sector shall include energy, okay, natural resources, sectors such as oil, gas, coal, mines, submarine cable system, and startups, and any other sector or subsector as deemed fit by the central government. Okay, so friends, why the strategic sector? If you remember, we have a restriction of limited liability structure for the foreign entity. Okay, but in case of strategic sector, this limitation is not there. Okay, so please take into consideration the strategic sector becomes very important if any investment is coming from these strategic sectors. Okay, so accordingly we need to keep in mind the structure of the foreign entity. Under the new ODI regime, the restriction of limited liability structure of foreign entities shall not be mandatory for entities with core activities in strategic sector. Accordingly, overseas direct investment can be made in such sector in unincorporated entities as well. Okay, so this is very important. Specific cases for RBI approval. Okay, so in the existing ODI or old ODI regime, so such kind of scenario like deferred payment of consideration, investment disinvestment by a person resident in India under investigation by any investigative agency or regulatory body, issuance of corporate guarantee to or on behalf of second or subsequent level step down subsidiary, right of of equity or investment on account of disinvestment. Okay, so in this category there was a requirement of RBI approval. Okay, but in new ODI regime the requirement has been dispensed with. So if any four categories happening under the new ODI regime, then RBI approval is not required. Then no objection certificate. So in the ODI regime, there was certain restriction where the ODI was made from the entity which is NPA or under investigative agency investigation. But now in the new ODI regime, the provision is given like any person resident in India having an account appearing as NPA or classified as willful defaulter or under investigation by a financial regulator, investigator shall obtain NOC from the lender bank regulatory body investigative agency concerned in accordance with the rule 10 of Y rule before making any financial. So now the investment is allowed, but only thing you have to get the NOC from these agencies. So with introduction of this provision, control is given in the hands of lender investigative agency to allow further financial commitment in such cases. Okay, then pricing guidelines. So again, this is again very important thing, because when the investment is made, so in the existing ODI regime there was certain provision. So the important thing was for the purpose of investment under this regulation by way of remittance from India in an existing company outside India, the valuation of shares of the company outside India shall be made where the investment is more than 5 million. Okay, so 5 million by a, so in that case by a category 1 merchant banker registered with Security and Exchange Board of India or investment merchant banker outside India registered with the appropriate regulatory authority. So this was the requirement for the purpose of valuation of shares. In all other cases by a chartered accountant or a certified public accountant. Okay, so these were the requirement under old ODI regime. But under the new ODI regime, what is changed? The AD banks, okay, the AD bank before facilitating any overseas investment related transaction shall ensure compliance with provision contained in Rule 16 of Y rule with respect to the document to be taken. Okay, the document to be taken here, this is the important thing, the document to be taken by the AD bank, they shall be guided by their board approved policy which may inter alia provide for taking into consideration the valuation, okay, as per any internationally accepted pricing methodology. Okay, so now it is now on the AD bank to have a board approved policy with respect to the document to be taken and the pricing methodology. Okay, earlier the RBI had provided the provision with respect to the valuation of shares, and there was no clear cut guidelines with respect to what document to be obtained. But under the new ODI regime, RBI has made it clear that AD bank can form a board approved policy with respect to these two two issues. Okay, so friend, with this I conclude my video. Hope you like this video and it will add some value addition in your curriculum. So thank you. Thanks for watching this video. Thank you very much.